Hello, good evening everyone. This is the session number 3rd of chapter number 9, transfer pricing. In previous session, we were discussing about question number 10th. This was the question which we were dealing with in the previous session. X Limited has two divisions, A and B, which manufactures product A and B respectively. A and B are profit centers with respect to divisional managers given full responsibilities. Here we were required to do the 3 requirements. We have done 2 requirements. Third requirement was X Limited as a whole. So let me first let's see what we have done in previous session. See, this is the question number 10th. Question number 10th, which we were doing. X Limited, Division A, Division B. It was having external market and internal transfer. We have done the external sales of 18,000 and 2,000 internal transfer. As per ranking number 1 and ranking number 2, and the best strategy for department A was this, to do the external sales of 18,000 and internal transfer of 2,000. Accordingly, we have prepared a contribution statement, and this was 10,34,000 was your contribution under best strategy of division A. Second requirement, under second requirement, B Limited, department B, given that A will use its best strategy, we have to find out division B or department B best strategy. If division A uses its best strategy, so here we have 2 options for division B, department B. Number 1, either it can do the external sales of 26,000 units and no sales to S Limited, because S Limited has a condition that either 6,000 units or no units should be sold to him. Option number B, first we can fulfill the demand of S Limited, that is of 6,000, and the balance 22,000 can be sold in an external market. Why we are doing so? Because in option number A, when we were selling extra to the external demand 26,000, our capacity was 28,000. 2,000 units were spares which can't be used. We cannot either sell in an external market or cannot be transferred to the S Limited. So that 2,000 units we are not able to earn any contribution on those 2,000. So let's see, we have another option. Either we can first fulfill the demand of 6,000 units of S Limited and then transfer to the external sales. Then accordingly, we found that after calculation that option B, option second, will be more fruitful. Here we were earning a total contribution of 19,60,000. So the best strategy for division B would be the option number 2nd. Okay. So now let's deal with the option number, part number 3rd. What is the part number 3rd? It speaks X Limited as a whole. We have to find X Limited as a whole best strategy. That is a company as a whole. See, this is the 3rd part. This is the 3rd part, and X Limited as a whole. Right, X Limited as a whole. So let's see. Number one, you might be thinking that both division are already has opted the best strategy for them, so it would be in the best interest of the company as a whole as well. But mind that rule is generally division X plus best strategy of division X. This is a rule that best strategy of division 1 plus best strategy of division second will become the best strategy for company as a whole. It will become best strategy for company as a whole, right? But it has an exception. But, or you can say it as subject to, if there is external purchase involved, then above condition need to be checked. What is it? Let me tell you. See, generally it is always seen when one division is already is exercising no external purchase is involved. That means if one division is transferring to other division and other division is already purchasing, whatever may be the transfer price, it will be set off. And see, if we take a money from one pocket and keep it in second pocket, it is going to be with me, right? But what happens if I take the money from my pocket and keep in someone else's pocket? That is what, when we are involved in external purchase, divisional best interest need to be verified whether it is also in the best interest of the company as a whole. So whenever there is external purchase involved, then only we have to see this. And in this case we were involved with the external purchases. So this is the reason why I am going to again calculate whether in divisional interest will be in the best interest of the company as a whole. Right. Mina, is it now clear? Video got stuck. Please tell me whether it is clear. Okay. So see, as per normal situation, as per normal situation, division A and division B. Division A, profit of division A under best strategy 10,34,000. Profit of division B under best strategy is 10 lakh 9 lakh, it's 19 lakh 60,000. 19 lakh 60,000. So the total is 10 lakh 34,000. 10 lakh 34,000 plus 19 lakh 60. It's okay. Meena sir, can you please explain? See, this point is very simple. Here I am giving you only one condition. Generally, best strategy of division 1 and best strategy of division 2. If both division is already following its best strategy, it will become a best strategy for company as a whole. This condition only works if there is no external purchase involved. This is what I have written here. If only if no external purchase is involved. But if you see this division B is purchasing its requirement. It's purchasing its requirement from the outside. So this is what the condition I am trying to explain you. There is nothing point of where you might get confused. I have simplified in a more manner that now consider it this only if no external purchase is involved. In the given case, in this given case, division B was involved in purchasing from outside market. It was purchasing 2,000 units only from the internal division A, and rest of its requirement was procured from outside market. So in this case, this situation, we need to check. We will be checking it. We will not be saying that this is going to be the best strategy of a division as a best strategy of company as a whole. Generally, what student will consider that both division is already following its best strategy. So this automatically will become a best strategy for company as a whole. Best strategy for company as a whole. But here we need to check this. Why we need to check this? Because there is external purchase involved. In this case, external purchases are involved. So we need to verify that those decision whether to purchase from external outside is in the best interest of the company as a whole. Okay, so how we are going to verify this, or check it? So number one, Number one, see, if we are purchasing from outside market, we are purchasing at 160 rupees. Is it clear? Yes. We are purchasing from outside market. That is division B. Division B purchases from outside market it's 160 rupees. Fine. Now, what is the cost? What is the cost to division A? What is the cost to division A if it transfers? If it transfers to internally, if it transfers internally by sacrificing its external. See, generally, division A has followed its best strategy, that the higher contribution, because it is earning. Because this division is getting higher contribution, 52 rupees on external market. So definitely this division will do the external sales as maximum as possible units. So it has done 18,000 units has been sold in external market, and the balance 2,000 units has been transferred internally. Can we see that just because of difference of 3 rupees, because from the internal transfer, it is going to earn 49 rupees contribution. Just to earn 3 rupees additional contribution, division A has taken a decision that might result a loss to the company as a whole. How? If you see, what is the cost? Division A if it transfer all units to division B, the cost will be, first, the variable cost. What is the variable cost in this case? It will be 25 rupees. It will be 25 rupees, 50 rupees, and 20 rupees. That is 95 rupees in this case. Variable cost on internal transfer, it's 95 rupees. And what is the contribution lost? Because it has an external demand, external sales. If it does internal transfer, rather external sales, it will lose the contribution. So let's lose the contribution on external sales and transfer to the internal division. So opportunity cost will be the contribution foregone on external sales. What is the contribution foregone on external sales? It's 52 rupees. This is 52 rupees. Okay, so let me do this. Add. It's 52 rupees. If I add this, it will come 147 rupees. What it is going to come? It's 147 rupees, a cost to the company. It is a cost to the company. I can say cost to the company if it transfers all units to division B. That is what 147 rupees is the cost to the company. Now see this. If you are a company, consider yourself as X Limited as a whole. You are a company. You know that this division A has a cost of 147 rupees, which can be transferred to division B, but division B is forced to purchase from outside market. At what rate? It is forced to purchase from outside market. It's purchasing from outside market at a rate of rupees 160. See, I have considered here the opportunity loss also. Whatever I was earning from from external sales, I have considered here. That is 95 rupees plus 52 rupees was the contribution which I was earning from the external sales. So it in the best interest of the company, division A should not do the external sales. It should transfer all 20,000 units to division B. Otherwise, division B will be forced to purchase at a higher rate, that is at 160 rupees from the external market, which is not in the best interest of the company. See how a suboptimal decision has been taken by division A. How a suboptimal decision has been taken by division A. From the company viewpoint, we know that this component is produced at 147 rupees. If we consider the opportunity cost also, this component will cost us 147 rupees. Why I am need to pay 160 rupees to the outsiders? Right? Why I need to pay 160 rupees to the outsider? I need not to pay to the outsiders. This is what? Okay, fine. After this, in the best interest of a company as a whole, what they have to do? Division A should transfer all 20,000 units to division B. It should transfer all 20,000 to division B. In this case, when they will be transferring all 20,000 units to division B, what will be the contribution of division A? That is, it will be 49 because it will transfer at 144 rupees. So at 144 multiplied by 20,000, 149 rupees as the contribution will be multiplied by 144 contribution of division A 49 rupees is the contribution on internal transfer. Internal transfer 20,000 units. 20,000 units. What will be the contribution of division B? Contribution of division B. That is option. Its best strategy is option number second. Option number second. That is to sell 6,000 to S Limited and 22,000 to the external market. So contribution on external sales 22,000 units. 22,000 units and internal let's bifurcate as 20,000 units. 20,000 units will be taken at 20,000 units on the external sales. The 20,000 units will be taken at 90 rupees. Why? Because it has been transferred at 144 rupees. It has been transferred at 144 rupees. So we are going to take at 90 rupees 20,000. That is 90 rupees and 2,000 units at 74 rupees. This 20,000 is internal transfer. That is material purchase, material received from internal transfer, and this 2,000 is material from outside purchases. S Limited contribution. This is S Limited sales contribution. $6,000 units into this. All 6,000 units will be procured from material outside purchases. See, the division B requires, the division B has total 28,000 units sales. So definitely it will be produced as well. To produce 28,000 units, it requires 28,000 units material, but 20,000 has been transferred from division A, so it only need to purchase from outside 8,000 units. 2,000 has been considered here and 6,000 has been considered here. 90. 60 into S Limited sales, 60 into material purchase. What is the contribution? Yes, it will be taken at 50 rupees at a higher side. That is purchase at 160 rupees. Purchased at 160 rupees. So can you tell me the calculations? Can you tell me now the calculations? $20,000 into 90, it will be 18 lakh rupees. 2,000 units into 74. It will be 1,48,000, and 6,000 into 160, this will be 9,60,000 rupees. Okay. So let me do the total contribution of division A plus division B, of division A plus division B. So this is 20,000 into plus 18 lakh. Yes, total contribution of a company as a whole. Very good, Tejal. It's 32 lakhs 28,000. 32 lakhs 28,000. This is the contribution of a company as a whole. Now, see the difference. See this difference. When we have presumed that division are already exercising their best strategy, so it will automatically become the best strategy of a company as a whole. Accordingly, that when we presume this, our total company contribution was 29,94,000 rupees. But there was external purchases involved. There was outside purchases involved by the division B, and that was not in the best interest of the company as a whole. So what we have done, we have calculated all things and came to know that the best strategy, or for the best strategy for company as a whole, will be that division A should transfer all 20,000 units to the division B. In that case, company as a whole contribution will be 32,28,000. So let's cross check. 2994. Difference. The difference is 32,28,000 minus 2994. $32,28,000 minus 2994. 2,34,000 is the difference. 2,34,000 rupees is the difference between the profit, and this profit has arisen because you can check 18,000 units. On 18,000 units, the company was losing 13 rupees. The company was losing 13 rupees. That is 18,000 multiplied by 13. This comes to 2,34,000 rupees. This 18,000 previously was sold externally by division A, which was not in the best interest of the company. That's why the division B was forced to purchase at 160 rupees, and the cost to the company was 147 rupees. So the net 13 rupees difference on 18,000 units was in the profit. This is what I was trying to convey you when I have given you this statement. When I have given you this statement, I was trying to just convey you. I was trying to convey you this thing. Generally, see, best strategy of division 1, best strategy of division 2 will automatically become the best strategy for a company as a whole, but only only if no external purchase is involved. If external purchase is involved, then it means we need to verify, we need to check whether that external purchases which has been done was in the best interest of the company as a whole, whether we have not paid any extra amount. We have not paid any extra amount. If we have not paid extra amount, that condition will be satisfied. But here we were paying 13 rupees extra to the external outside person. This is the reason why our profitability in both cases, will be different. So this is the best strategy for a company as a whole. This will be the best strategy for company as a whole. What is the best strategy for company as a whole? The division A should transfer all 20,000 units to internal division, right? This is what. And division B will only purchase 8,000 units from external market, from the outside market, and 20,000 from internal division. It will sell 6,000 units to S Limited and 20,000 units to 22,000 units to the external market. This is what the best strategy already followed by division B. So this will be the best strategy for a company as a whole. Any doubt, any query you can ask. Any doubt, any query you can ask. Yes, okay. Here I have made a mistake. It should be 50 rupees. It should be 50 and this will be 3 lakh. This will be 3 lakhs. Okay. Any doubt, any query regarding this? Any doubt, any query regarding the company as a whole best strategy? If there is no query, we are going with institute questions. Everyone come to the question number 1. Question number 1, please everyone come to this question. We are going to test this question. Question number 1, basic concepts, test your knowledge on page number 9.33 of ICAI study material. G is transferring division, right? We will be having 2 division, one transferring division, one receiving division. So here the transferring division is G division, receiving division is R division. R has a demand for 20% of G's production capacity. That means R is demanding. For example, let's the total capacity of G is 1 lakh units. So the R demand will be 20,000 units from G Limited. Capacity which has to be first met as per the company policy. That means first it will meet the internal demand, then it will do the external sales. State with reasons. You have to also state the reasons. Which division, G or R, enjoys more advantage in each of the following independent situations, assuming no inventory build-up. Okay, so which division will be in more advantage situation? Situation number 1 is G transfers to R at transfer price equal to, that means here the transfer price will equals to full cost, but no markup, no profit has been added. G's production level is 60%. Currently, they are producing at 60%. External demand is 40%. That means 20% they are transferring to internal division. Which division have the more advantage, and you need to tell the reason whether division G has the more advantage or division R. Which division has more advantage? Everyone, please answer. I am waiting for your answer. Please answer. Everyone, please answer this. Which division will have advantage here? Division G or division R? Which division is going to have advantage? C. G is transferring. G is transferring. Situation first. G is transferring at full cost. Full cost means variable cost plus fixed cost. Variable cost plus fixed cost. So definitely division G will be having more advantage. Why? Because this fixed cost is an irrelevant cost. Why? It has already installed a capacity of 1 lakh. So whatever the cost which relates to the fixed capacity is an irrelevant cost, sunk cost. So if it is able to recover the fixed cost from division R, division G is in a beneficial situation. Division G is in a beneficial situation. Division R more advantage because yet cost at without markup. No. Division G is in the advantageous situation in situation number 1. So G. Why? Because fixed cost will be recovered. G transfers to R at a transfer price equals to market price. G transfers to R at transfer price equals to market price. That is, if G's production is 80% and it's 60%, that is, who will be in the most advantageous situation? Again, the division G is in the best, is in the advantage because it's able to recover the fixed cost. It is also able to gain some profit. Because it is transferring at the market price. It's having the demand, external demand only 60%. That means the spare capacity, it is transferring the spare capacity at a market price. Spare capacity at market price. Fine. Marginal cost G's production level, external demand 80% and this is 100%. If this is transferring at 80%, which division will have more advantage? Definitely in this case, division R has a more advantage. Division R has a more advantage because it is receiving at a marginal cost. Otherwise, it has to purchase from outside market at a higher price. So division R will be at advantage situation. G's production capacity, production level is 100%, external demand is 80%, market price is 100%, and this it is transferring at 100%. G's production level 100%, external demand 90%. This is at 90%. So definitely in this case, G division will be at more advantageous situation. Why? Now, it has 100% capacity. It has 100% capacity. It can sell at 90% in the external market. Balance 10% is the spare capacity. If by transferring 20%, it need to sacrifice 10% from here. And yes, the 10% which was not able to sell in the external market will be transferred to division R, but at the rate market price. So what will be the situation? This will be called as, who will be more advantage? Division G will be having more advantage because this 10% has been transferred to division R at a market price. Now please see their reasons. Let me explain you once more so that those students who are facing the problem, which division will be getting more, will be into the more advantageous situation. So we have company G and R, right? Now see, in first situation, G was transferring at full cost. G is utilizing only 40% of its capacity by selling to the external market, which implies G might have not been able to recover its full fixed cost. Definitely, if it is only able to sell 40% in the external market, it will not be able to recover its full fixed cost. By transferring 20% of its production capacity to division R at full cost, G will not be able to recover fixed cost component. G will be able to recover the fixed component. If it is transferring 20% capacity to division R, it means division G will be able to recover the fixed cost component on these 20% from division R. So definitely division G will be in more advantageous situation. Second situation, it is transferring at market price. G will not lose any external market demand as it is within its production capacity. As it is in the production capacity. By transferring 20% of its production capacity to division R at market price, G will earn extra contribution towards the fixed cost and profit. G will earn extra contribution towards the fixed cost and profit. So if G will transfer 20%, which is not hampering my external sales, so on those 20%, I will be recovering two component, fixed cost and profit. See, G will be beneficial. G will be always beneficial. Where it will be, see, there are three components. Where variable cost, fixed cost, and profit. This will become equals to selling price. So in all those situations where G will be able to recover fixed cost or profit, in those situations, division G will be in an advantageous situation. And where division R will be in advantageous situation, where it will receive at a variable cost. Division R will be at an advantageous situation where it will receive at a variable cost. So you can take this from this point that if division G is able to recover its fixed cost, it will be in the advantageous situation. And also if it is able to recover profit, then it is again in the advantageous situation. R will be happy if it receives at a variable cost. Tejal, sir, if in the last situation G transfers to R at a marginal cost and out of 100% production level, there is 90% external demand, then in that case, division R will be in an advantageous situation. Division G will not be in an advantageous situation because it has to sacrifice 10%. It has to sacrifice 10%. See, 90% and 10% is spare, right? As per the condition, first 20% has to be internally transferred. And if it is supposed to transfer, it need to sacrifice 10%. So on those 10%, on these 10%, it will be able to get only variable cost. That means opportunity cost of contribution foregone has been arised but could not be recovered from division R. So this is the situation where division G will not have an advantage. Division R will have an advantage. In Tejal, it is as per your situation. So Suyeshi, is it clear now? Suyeshi, is it clear? Now please move to the illustration number. Yes, to the illustration number 3rd. We are moving to the illustration number 3rd. Centurion Company operates a pulp division. So let's draw. Question number 3rd. Centurion Company operates a pulp division that manufactures wood pulp. Centurion Company operates a pulp division that produces wood pulp, and the following information are available: selling price 210, selling price 210, Variable expenses 126. So the contribution is 84. Less fixed cost 54 rupees. So the net income is yes, Namita, you are correct. Net income is 30 rupees. Net income is 30 rupees already given in question. Now what it is saying, Centurion company has just acquired a small company that manufactures paper cartons. This company will be treated as a division of Centurion with a full profit responsibility. The newly formed carton division, it is a carton division. The newly formed carton division is currently purchasing 10,000 kg of pulps per year from a supplier at a cost of 210 per kg less 10% quantity discount. Okay. So what it is doing, it is purchasing outside purchase of pulp 10,000 pulps, 10,000 kgs at the rate rupees 210 minus 10% discount. So what will be the net price, final price to the carton division from the outside purchase? It will be 210 minus 10%, 189. 189 rupees is the price. 189 rupees is the price. Fine. Okay. What we have to do now? Let's see. Centurion president is anxious that the carton division begins purchasing its pulp from pulp division if an acceptable transfer price can be worked out. So the company president wants the carton division should start purchasing the pulp from the pulp division if an acceptable transfer price can be worked out. That means only if there is acceptable transfer price. Situation first. What is the situation first? If the pulp division is in a position to sell all of its pulp to outside customer at a normal price of 210 per kg, will the managers of the carton and the pulp division agree to transfer 10,000 kgs of pulp next year at a determined price? Explain with reason. Okay, so yes, Shafna. Situation number one, you need to analyze and then tell me whether the pulp division will be willing to transfer to carton division, and that carton division will be willing to purchase from internal division. Can be there any kind of transfer? Can be there any kind of transfer? See, if we consider situation number one, as the pulp division is operating at full capacity, it is operating at full capacity given in question. is operating at full capacity. That means any internal transfer will attract opportunity cost. So it means the minimum transfer price from the viewpoint of pulp division will be the variable cost, that is 126, and add opportunity cost, that is 210 minus 126. This will be 210 minus 126. It will be 84, and total is 210. It is what the minimum transfer price. And what is the maximum transfer price? Maximum transfer price that carton division can offer. It can offer only 189. It can offer only 189 as the maximum to maximum transfer price. And if you see both range, minimum transfer price says, the transferring division says, I will not transfer below 210. Receiving division say, I cannot pay above 189. So there is no possibility of internal transfer. There is no possibility of internal transfer. Very good, Shafna. Yes, Namita. Okay. So, with reason we have to explain. See, the lowest acceptable transfer price from the perspective of selling division is given by the formula. Transfer price should be greater than or less equals to variable cost per unit plus total contribution margin on the lost sales divided by number of units transferred. So we have calculated here, and it comes to 210 rupees. Therefore, the pulp division will refuse to transfer at price less than 210. Anything below 210, the pulp division will refuse. The carton division can buy the pulp from an outside supplier 210 per kg less to 10% quantity discount, 21, that is 189. Therefore, division would be unwilling to pay more than 189 per kg. Transfer price less than equals to cost of buying from the outside, that is 189. The requirement of two divisions are incompatible. The carton division won't pay more than 189. The pulp division would not accept less than 210. Thus, there will be no mutually agreeable transfer price, and no transfer will take place. There will no transfer will take place. Right? Situation number first. After this, we have to look at situation number second. Assuming that the pulp division is currently selling only 60,000 kgs of pulp each year to outside customers at a stated price of rupees 210 per kg. Will the managers agree to mutually acceptable transfer price for 10,000 kgs of pulp in the next year and explain with reason? See, when you have an explain with reason, you need to do the explanations. What it is saying is currently selling only 60,000. That means we have a spare capacity of 40,000. We have a spare capacity of 40,000. And it is selling outside at 210 rupees per kg. We know that. Managers agree to a mutually acceptable transfer price of 10,000 kgs of pulp in the next year. Explain with reason. Yes, they will be now agreed. Okay, so let's do the calculation. If moving to the situation number second, pulp division has a spare capacity, now a spare capacity of 40,000 kgs. And if any division has surplus capacity, there is no question of opportunity cost. That is, opportunity cost will not arise in this case. Opportunity cost is not going to arise. So the minimum transfer price, this is always from the viewpoint of pulp division. Okay. Minimum transfer price will be the variable cost rupees. Very good. Very good, Tejal and Namita. It will be 126. Opportunity cost will be nil. So the transfer price, minimum transfer price will be rupees 126. Maximum transfer price will be rupees 189. So the transfer price will range between 126 to rupees 189. Rupees 126 to 189. Good, Shafna, Kaushni, Radha Agrawal. The transfer price will range between 126 to 189. Now, the task with us is the explanation. The calculation part, all the students can do very easily. Calculation can be done very easily, but now this has to be explained with reasons. That means all the calculations need to be explained with reasons. This is what will be asked in your examination. Now see how you have to write your answer. It will be asked in your examination for 5 marks, right? So first we have to tell the pulp division has idle capacity. So the transfer of the pulp division to the carton division do not cut into the normal sales of the pulp to the outsider. That is, if it does the internal transfer, it is not sacrificing the external sales. In this case, the minimum price as far as carton division is concerned is the variable cost. This is confirmed in the following calculation. The carton division can buy the pulp from outside supplier for 189 per kg and would be unwilling to pay more than for the pulp in the internal transfer. If the manager understand their own business and cooperate, they should agree to transfer and settle on a transfer price within a range of this. That means a transfer price can be 130, can be 150, can be 160, can be 175, can be 188, and can be 189, but can't be 190. So at what price they agree, it will be transfer price. It will be the transfer price. This range speaks about the bearing capacity. It says that I can't bear lower than 126. It says that I can't bear more than 189. I can only pay 189 or something less than 189. It will be good for me. It says 126 is the minimum what I will be required to charge, and above that I will be more happy. Situation number third, if the outside supplier of the carton division reduces its price to 177 per kg, will the pulp division meet this price? You need to explain. If the pulp division does not meet the price of 177 per kg, what will be the effect on profit of the company as a whole? Understand what is the situation number third. It is saying that outside supplier of the carton division reduces its price to 177. earlier they were supplying at 189. Now they have reduced to 177 per kg. Will the pulp division meet these prices? Explain if the pulp division does not meet the prices of 177. What will be the effect on the profit of the company as a whole? If it is not able to meet, for example, pulp division refuses that I will not transfer at 179, 177. So what will be the effect on the profit of the company as a whole that we have done in a previous example, right? Okay, so let's see how it is going to affect. See, yes, number one, yes, the 177 is also acceptable. It is also acceptable to, it should also be acceptable to pulp division because the minimum transfer price is 126. Anything offered above 126 should be acceptable, bona fide to the outside price, even though 177 is less than the pulp division's 180 full cost price. If we consider the full cost, what is the full cost here? What is the full cost? See, if we consider the full cost, it is to 126 plus 54, 180. Although it is less than the full cost, it is less than the full cost, but fixed cost is irrelevant to us for here decision making. So the pulp division, it is within the range. Within the range means in this range, and therefore will provide some contribution to the pulp division. That means it is going to provide some contribution. So what happens if pulp division refuses, does not meet the price is 177? Then it will lose 5,10,000 in the potential profit. How that calculations comes? Price per kg is 177 rupees. What it is going to purchase from the outside, and the cost to the company is 126. That is the pulp wood, the wood could be manufactured at 126 rupees. Now that 126 cost has been at 177. That is, it is purchasing. The cost of that wood is 126. It is purchasing from the outside at 177. So definitely the loss to the company is 51 rupees per kg of wood. So 10,000 kgs will be purchased from the outside. So 5,10,000 potential increase in a profit would be lost. The loss of 5,10,000 the potential profit. This 5,10,000 in the potential profit applies to the pulp division and to the company as a whole. This will apply to the pulp division and a company as a whole. Right. For the situation third, also consider pulp division is currently selling only 60,000 kgs of pulp each year to the outside customer. So, any query from the third situation or question number third, you are free to ask. In third situation, if the outside supplier of the carton division reduces to price 77, there is a still benefit to the purchase internally at a minimum transfer price of 126 and profit of 51 will arise to the company. Very good. Tejal, Shafna, yes, 5,10,000 will be the potential profit which could have been earned, but as per the decision, it will be now lose. Pulp division will lose the contribution. Yes, Radha, Suyashi. Sir, in situation third, pulp division is working at full capacity or idle, or it has an idle capacity. It need to be assumed. See, this is what, as per this situation, we have to assume that the pulp division is having the spare capacity. The pulp division is having a spare capacity. This situation belongs to second situation. That is what, in this there has been a note given for the situation third. Also consider that the pulp division is currently selling only 60,000 kgs of a pulp each year to the outside customer. You can, right? So this is what the assumption which a student need to take. Yes, Namita, sir. Situation number third is independent, so we need to consider full capacity. Why we are mixing it with situation number second? See, we here in the question it has not clearly specified what should be the capacity level, right? So if the capacity level has not given to us, we have only two options: either to consider at a full capacity or to consider as a spare capacity, right? That is, it is operating at 60,000. So a student can show both requirements. What if it is operating at full capacity? What if it is operating at full capacity? Then definitely the profitability, if it refuses to transfer at 177 rupees, there will be no impact on the profitability, because it is not involved in the internal transfer. The receiving division will be benefited from purchasing outside at 177 rupees, and the transferring division will gain the extra benefit from selling the external market if it is operating at full capacity. So there is no point of the lose of the contribution. So definitely both division will be earning good. But if the company has a spare capacity, then the company will lose 5,10,000 rupees. This is also the situation. It has been explained there. That we need to consider, because if we consider that company is operating at full capacity, there will be no impact on the profit. But yes, if there is a spare capacity, it is going to impact the profitability by 5,10,000. Any further query regarding this question number third? If you have any query regarding question number third, you can ask. Any query regarding question number third? Or situation number third, situation number second, situation number first? So we are going to take a break. After the break, we will continue some more questions. So there is a break of 10 minutes. Please come to the question number second. And this question is really very, very important, and you can expect this question anytime in your examination, and it is going to come for 20 marks. B Limited makes 3 products X, Y, and Z in division X, Y, Z respectively. The following information is given. So let's start with how we do it, the way we do it. Question number second. Company, and this has 3 divisions. Division X, Division Y, and Division Z. Division X, Division Y, and Division Z. It requires a material, direct material 8, 22, and 40. And it is saying excluding material X for division Y and Z. That means this division Y and this division Z requires the material of X division. So this will be direct material 8 rupees, 22 and 40, 22 and 40. Material X, I am just leaving a space. I am just leaving a space for this. Material X. Then direct labor 468. Four, 6, and 8. Right. Variable overhead 2, 2, and 2. Variable overhead 2, 2, and 2. Selling price to the outside customers is 25, 65, and 90. That is selling price. And this division is selling to the external and internal to 2 divisions. So the selling price is 25 rupees. The selling price here is 65 rupees. 65. And the selling price in this case is 90 rupees. Right. Existing capacity we have, maximum external market demand we have, additional fixed cost that would require to install additional capacity. That means we can now increase our capacity. We can increase our capacity by incurring additional fixed cost. By incurring 45,000 rupees, we can increase further 6,000 as a additional capacity. So the existing capacity is sufficient to meet the external demand. But in case, because they are saying that material will be required for division Y and division Z. For example, if we consider only the as per existing capacity or existing demand, there will be requirement of 6,000, minimum to minimum 6,000 from X and from Y and Z. So in order to fulfill our internal demand also, we can increase our capacity by further 6,000 units, but we need to incur a specific fixed cost of 45,000 rupees. Same with the division Y, that by incurring 9,000, we can increase 2,000 capacity. By increasing 2,000 capacity, we can fulfill total 5,000 units external market is still 500 units, demand will not be fulfilled. Then 300, 3000, 5000, and it is maximum additional units. Okay. Fine. So our maximum, external maximum demand is 5,000, 5,000, and 5,000. It's external demand, right? It's external demand. It's 5,000 units. Its capacity is 6,000 units. I will be adding it. I will be adding to this capacity. And this external demand is 5,500 units, and 5,000 units is the demand. This is demand. Capacity, if we talk about the capacity, it's 3,000 and 3,000. 3,000 plus 3,000 and plus. Right? Maximum additional, this we have taken. Now, Y and Z need material X as their input. It will need material X as their input. We have already noticed there. Material X is available in the market at rupees 23 per unit. This is available in the market at rupees 23 per unit. Fine. What we have to do? Material 23 rupees per unit. So we know that material X is available in the market at rupees 23. Market, outside market. And this X will be used by division Y, and this X will be used by division Z. X, okay. Defectives can be returned to the suppliers at their cost. That means if there is a defective material, we need to incur transportation cost and return to the supplier. The supplier will take, but we have to incur a transportation cost. The division X supplies the material free from defect. If division X will be supplying the material, it will be completely free from defects, and hence is able to sell at 25 rupees per unit. This is the reason why it is selling in the external market at rupees 25. Each unit of Y and Z requires 1 unit of X as an input with a slight modification. Okay. So 1:1 is the input output ratio. 1:1 is the input output ratio. If division Y, if Y purchases from outside at rupees 23 per unit, it has to incur 3 rupees per unit as a modification and inspection cost. That means if it purchased from outside market, is still it has to incur 3 rupees for inspection because it could be a defective material, or for the modification. So the total cost outside cost will be 23 plus 3 will be 26 outside cost to division Y. If X purchases from division X, it has to incur, in addition to the transfer price, rupees 2 per unit to modify it. That means transfer price plus 2 rupees to modify. This is the modification cost. Modification. If Z gets the material from division X, it can use it after incurring a modification cost of rupees 1 per unit. that is transfer price plus 1 rupees. If Z buys X material from outside, it has to either inspect and modify at its own shop floor by incurring 5 rupees or use the idle labor from division X at rupees 3 per unit. That means they can hire the idle labor of division X and they can pay them 3 rupees, but it has to be incurred by division Z. Division X will lend its idle labor as per the Z requirement even if Z purchases the material from outside. So now it has two options. See, it has two options for the outside, from the outside. Option number 1, 23 plus 5 rupees. Option number 2, 23 plus 2 rupees. 23 plus 3 rupees. Plus 3 rupees. So can you tell me which one is a better option for division Y, division Z, if it is purchasing from outside? Definitely option number 2 is the best. This will be the best situation, best strategy for division Y, because here it need to pay 26 rupees to the outsiders. Here it need to pay 28. So definitely he will be opting where he will be hiring or borrowing the labor hours from X and paying them 3 rupees per unit. This is what 26 rupees will be the outside cost to division Z. But if it purchases from division X, it need to pay the transfer price plus 1 rupees for the modification. The transfer price are at the discretion of the divisional managers and will remain confidential. That means it is not that it is this division X can charge different prices to division Y and division Z. That is what it is completely at the discretion of division X and it will remain confidential. It will remain confidential. That means division Y will not know what has been charged to division Z and division Z also will not know what has been charged to division Y by division X. It will remain completely confidential. That means the transfer price will not be same for division X and division Z, division Y and division Z. Assume no restriction on the quantities on internal transfer units or purchases required. Discuss with relevant figure the best strategy for the each division and for the company as a whole. So first we have to calculate what will be the best strategy for each division and then company as a whole, right? Number one, can you tell me what is the contribution on external sales? Contribution on external sales, what is the contribution here? We have considered all, that is labor cost, material cost, variable overhead cost, right? So what will be the contribution? What will be the contribution? It will be 11 rupees. No, Namita, this means, see, X material is available at 23 rupees per unit. Defectives can be returned to suppliers. Who can return? It will be returned by division Y and division Z, but at their cost, not at the supplier cost, but at their cost. Return to the supplier at their cost. That means if division I am division Y, I will be bearing all the cost related to the transportation, the cost incurred to return the defective unit. So defective cost will be incurred, the cost will be incurred by the divisions. Yes, Shafna, 11 rupees is the contribution here. Okay. Now let's decide what should be the transfer price to division Y. Number one, what should be transfer price to division Y? This has to be decided by you. You will be answering me what will be the transfer price here. I have to put. What will be the transfer price? What will be the transfer price? See, generally division X, variable cost is 8 rupees, 4 rupees and 2 rupees. That is total 14 rupees. But if division X will sell it at a variable cost, will transfer at a variable cost, he will not be motivated, he will not be involved in the transfer because it is not in the best interest of the division X. He has to exercise the best strategy for division X. So division X would require the maximum to maximum what division Y can offer. So what division Y can offer to division X? Can you tell me what division Y can offer to division X? Division Y will offer what it is offering to the outside market. It is offering to the outside market 26 rupees. So it will say that my maximum paying capability to you will be 24 rupees because I have to incur 2 rupees as a, so I will now write here as a modification cost, right? Modification cost. 2 rupees as a modification cost and material X will be 24 rupees. Will be 24 rupees. The transfer price charged for material X will be 24 rupees. This is the transfer price, right? That is the maximum ability to pay. Maximum ability to pay will be 23 plus 3, right? It is the minus 2 rupees modification. This comes 26 rupees as to the outside, to the outsider. So it will be maximum ability to pay will be minus, or you can write it in a very simple manner, that outside price minus 2 rupees as a modification cost. So outside is rupees 26 minus 2 rupees. It will be rupees 24. Very good, Radha, Kaushni, Shafna, Sachin. It's 24 rupees. I hope so everyone who is watching this lecture is able to understand why the transfer price will be 24 rupees. First, we have calculated what division Y is willing to pay to the outsider. Is willing to pay to the outsider 20. He's paying 26 to the outsider. So the same amount is the maximum amount which he can bear. So modification cost will be 2 rupees. So his ability to pay to division X will be 24 rupees. What will be the transfer price for division Z? Can you tell me what will be the transfer price for division Z? Everyone, please tell me what will be the transfer price for division Z? ₹26, and it is incurring modification. Thank you so much, Lakshman. What will be the transfer price? What will be the transfer price? What will be the transfer price? Here, very good, Sachin, Namita, Kaushni. It will be 25 rupees. How we have arrived at? See, if we consider the two options to the outsiders, option number 1 is 28. Option number 1 is the 28, and option number 2 is 26. So definitely division Z will choose 26 rupees option for the outside supplier, right? So he's willing to pay 26 rupees maximum to maximum. If it involves with division X, the transfer price is 26. The transfer price plus 1 rupees will be involved in a modification cost. So transfer price in this case will be 25 rupees, 1 rupees modification. Total cost will equals to 26 rupees what he's paying to outsider. So his ability to pay will be 25 rupees. 25 plus 1 will become 26 rupees. So transfer price will be 25 rupees. And 1 rupees will be a modification cost. This 1 rupees will be a modification cost. Good, Suyashi. So now can you tell me what will be the contribution? What will be the contribution in this case? 65 minus 22 minus 24 minus 6 minus 2 and minus 2. This will be 9, and 90 rupees minus 40 rupees minus 25 minus 8 rupees minus 2 minus 1. Let me recalculate it again. 90 rupees is the selling price minus 40 rupees minus 25 rupees minus 8 rupees minus 2 and minus 1. That is 14 rupees. Right. So we have now the modification cost. Now see this. The best strategy, generally how we determine what will be the best strategy. To have the best strategy, Radha sir, but Z also pays 3 per unit for the labor to X division. This will be incurred when it will purchase from outside. This 3 rupees is the cost of outside purchases. This cost, right? It is not involved in the internal transfer. It is involved in the outside. So division Z has to decide whether he wants outside or he wants internal. So definitely division Z will choose the internal. I am going to tell the reason why division Y and division Z will choose internal transfer rather than external purchase. See, the quality of division X is the defect free. If they purchases the material X from division X, that is going to be defective free. So the best strategy for division Y is not to purchase from outside, is to purchase from the internal division. For both division Y and division Z, it will be in the best interest that they purchase from internal division rather from outside purchases. You might be thinking that why division Y will be bothering? They are paying same amount to the outsider, same amount to division X. So what will be the best? How it will be counted as a best strategy? It is in the best interest to purchase from internal division X because it will be defective free. If division Y purchases from outside, that will be a defective material. It need to be returned to the supplier, and division Y will be incurring some cost for returning that. So it is in the best interest of division Y and Z to purchase from material X from division X. Right. So, okay. Let me tell you a mantra, a key point, how we should evaluate a best strategy. See, what is best strategy? Generally, we have an alternative options. And to evaluate each option, which will be a best course to us, this is called as a best strategy. So whenever you are evaluating, whenever the question asks for a best strategy, please look at all the options. That means the option will determine the best strategy. So can you tell me what are the options available to X division? What are the options available at X division? Can you tell me? See, the first option, whether to expand the capacity or not, whether to expand capacity or not, that means division X has to decide whether he will incur fixed cost in order to do the internal transfer or not. So how this will be decided? This will be decided by the benefit received by expanding the capacity and the cost it incurs. Okay. What other option division X has? What other option it has? Expand capacity and second to transfer to which divisions, transfers to which divisions and what quantity. See, if I see the requirement after expansion, it can ask me 5,000. See, if it is going to expand its full capacity, it can sell 5,000 units and it can also sell 5,000. So 5,000, 5,000, 10,000. And we already have 5,000 units, 5,000 units capacity, 5,000 units capacity, external demand. So here the total requirement will be 15,000. Total requirement will be 15,000. Now it is the point of deciding factor for X. First, to which division it should transfer. See, the maximum capacity it can increase is 6,000. Existing capacity is 6,000, and after increasing, it can also it can reach at 12,000. So this division can maximum go at 6 plus 6, that is at 12,000. At 12,000 is the capacity, maximum capacity. But if we consider all internal and external demand, 5,000, 5,000, 5,000, the total demand is total 15,000. But the capacity is limited. How it will decide? First, to whom division it should supply. So definitely the contribution per unit matters to this. So 8 rupees, 4 rupees and 2 rupees, 24 rupees, right? And 25 rupees, 8 rupees, 4 rupees and 2 rupees. What the contribution it is going to earn, from here? 11 rupees. And from here, it is going to 10 rupees. So you can see this. If you are a division X, first you will try to fulfill all the demands of division Z. And the balance units should be transferred to division Y. First, it will meet its external demand, then Y, then Z, and then Y. Right? So generally, when we have to decide what is the best strategy, so what we will look at, what are the options available at X? Number one option is to whether to expand or not. This is also a decision. Division X has to decide whether it will be able to recover all fixed cost or not. If it is not able to recover fixed cost, it is not going to expand the capacity and it will do the external sales only. Number one. Number second, if it decides to expand, then how much units? Already it has 1,000 spare capacity. It can decide that 1,000 units to which division it should transfer. So that has been calculated from the calculation of contribution per unit. The contribution per unit from division Y and Z. Division Z is giving us higher contribution. So our first priority will be division Z. For division Y and for division Z, it is in the best interest to purchase from division X, right? And yes, division Z option to division Y will be one, whether to expand or not. Option Z, whether to expand or not. Right? We have already decided that these divisions are going to purchase from internal division. So for this problem, we need to prepare a statement. We will be preparing a statement. Decision regarding expansion of capacity particulars X, Y, and Z. Existing capacity the existing capacity is 6,000, 3,000, and 3,000. 6,000, 3,000, and 3,000. Additional capacity, if we consider additional capacity, it's 6, 2, and 2, 250. 6, 2,000, and 2, 250. So total capacity will be 12,000 units, 5,000 units, 5,250 units. Right? Okay. Additional fixed cost. What is the additional fixed cost here we are incurring for the additional capacity to install is 45,900, 45,000, 9,000, and 23,100. 23,100. It is what the additional cost we are incurring. Right? We need to now check. We need to check if we increase our capacity. If we increase our capacity, that increased capacity will be sufficient to recover that 45,000 rupees cost or not. We know that we have increased this 6,000. We know that we have increased this 6,000. Right? Are we able to recover these 45,000 rupees cost from the increase additional capital of 6,000? These 6,000, see, this 6,000 increased capacity will revenue from or contribution from additional capacity. These 6,000 units will be used to transfer to Z and to Y, right? We will assume that, presuming Z also increase their capacity, Y also increase their capacity. So 4,000 units, the demand of market demand, it will be subject to the market demand. The capacity will be subject to the market demand. Market demand is 5,000, 5,500, and 5,000. Right? 5,500, 5,000. So here the demand will be of 5,000. Here they can demand, but they know that only the total capacity is 5,000 units. So the production will also be done for 5,000 and the sales demand will also be for 5,000. Right? Okay. Our first priority is to fulfill the demand of division X, division Z, right? You know that we were having only 5,000 as external demand. 5,000 as external demand. That means these 5,000 can be fulfilled from your existing capacity. Still we have 1,000 units as surplus capacity, as a spare capacity. These 1,000 units demand will be first diverted towards the Z. That means now it requires 4,000 additional units from the additional capacity. 1,000 can be fulfilled from the existing capacity. 4,000 units will be diverted towards Z. So Z 4,000 units. 4,000 units multiplied by 11 rupees, the contribution it is giving. Why 2,000? This 2,000 is a balancing figure. Multiplied by 10 rupees. If we consider the total contribution, it will be 44,000 plus 20,000, 64,000 rupees. It will be 64,000 rupees. Clear? That means here we will have a surplus. Here we will have surplus of 19,000. Here we are going to have a surplus of 19,000. Fine. Our decision should be to expand. Our decision should be to expand. Right? Okay. What will be the case here? See, we have increased the capacity by 2,000 units. That will be used to do the external sales. Through external sales, this division will be able to earn 9 rupees. Will be able to earn 9 rupees on 2,000 units. So 2,000 units into 9 rupees, that is 18,000. 18,000 is the revenue. Surplus, we have a surplus as 9,000. So definitely we need to expand, because we know that if we increase our capacity, we add our capacity, we have to incur 9,000 as a additional fixed cost. But all our 9,000 cost will be recovered, because our additional contribution from external sales will be capacity. External sales on additional capacity. What will be here situation? We have 2,250. But it will be restricted to 2,000 only, because our market demand is 2,000. So 2,000 units into contribution is 14 rupees. 28,000. It will be 28,000 rupees. So we can see here we have a surplus 28,000 minus 23,100. It will be 4,900. 4,900 as a surplus. So in all the three situations we have a surplus. For simplicity purpose, first you decide here, then decide here, and then you can do the calculation for this. Then go with this. I have directly done assuming that they will expand, but we can easily see that we can expand and there is a surplus. This is the reason why expanding. So based on the expansion decision of Y and Z, division X is also expanding 6,000 units, and it is also able to recover its 45,000 rupees as a fixed cost. Yes, very good, Tejal and Shafna. I hope so. This point is clear to everyone. Now let's decide how many number of units is transferred to division Z and division Y. Number of units transferred to division Y and Z by division X. Division Y and division okay, Suyashi, see, we have previously we have a capacity of 3,000 and additional capacity can be added 2,250. The total capacity will become 5,250. But our market demand is limited to only 5,000. That means even though our capacity increases to 2,500 units, we could be able to sell only 2,000 units. This is what I have marked here. Able to sell additional units, 2,000 units. So although we are increasing our capacity 2,250 units, but our external sales, we can't sell 2,250 units. We cannot sell 2,250 units because already we were selling 3,000 units from the existing capacity. This is the reason why we have taken 2,000 here. Clear, Suyashi? First priority is division Z, right? So 1,000 units from spare capacity and 4,000 units from additional capacity. Total 5,000 units will be transferred to division Z. Division X has total capacity of 12,000. So external sales 5,000 transfer to Z, it will be 5,000. Now it has only 2,000 units remaining with it. So transfer to Z, transfer to division Y, it will be 2,000. This 2,000 is a balancing figure. Total 12,000 units. Division Y, internal transfer from division X will be 2,000 units. It need to purchase from outside as well. Purchase from outside. It has to purchase 3,000 units from outside market, and this is what? Balancing figure. As we are paying the maximum transfer price to division X, in that case our contribution will not change. That means here we have calculated this material X. If it is purchased from outside market, it will be 26. Modification cost will not be incurred. 2 rupees, 6 rupees, 22 rupees, and the selling price still will be 65. And the contribution in this case will also be 9. It will be same. Okay. So we have discussed this. How many number of units should be transferred to which division? Expansion division decision has also been taken. And you know that you have to prepare a contribution statement. You need to prepare a contribution statement of division X, Y, and Z. You need to prepare division X, Y, Z, and total. Total basis, what will be your total contribution, right? So from the external sales, from internal transfer, and you have to reduce less additional fixed cost. We have increased our capacity, so 45,000 rupees will be reduced from here. 9,000 cost will be reduced from here, and 23,100 cost will be reduced there. So total fixed cost will be reduced there, and you have to consider internal transfer. Internal transfer is done for the 7,000 units. Internal transfer will be 5,000 units and 2,000 units multiplied by, it is 10 and 11. 11 and 10. External sales is 5,000 multiplied by 11. This will yield us 9 rupees contribution. It will yield us 9 rupees contribution on 5,000 5,000 and 14. You will get your total contribution. So what is the best strategy? What is the best strategy for company as a whole? First, individual division has opted its best strategy, that division X will exercise its option, right? That he will expand its capacity and will do the internal transfer. Division Y will opt for expansion. Division Z will also opt for expansion. Division Y and Z will choose for the internal transfer, as these are the defect-free material. Okay, fine. Now, I have told you, whenever there is external purchase involved, you have to check whether the individual division has taken a decision best in the company as a whole in the interest, or only for the division interest. How we will be calculating it? We will be calculating it through it is earning a 11 rupees contribution from external demand, right? It is earning a 11 rupees contribution from the external demand, and the same price it is getting from Z division. It is getting same price from the Z division. So its first priority should purchase from this division, and from it should sell in external market. Division Y, if internal transfer is not available, mostly because Z has not purchased, there is no purchase, no outside purchase. Here, yes, we have involved outside purchase, but the cost is the same. That is same cost it has to incur, that is 26 rupees. It is going to incur 26 rupees, and the same price it is paying 26 rupees to the internal division. It is same price paying to the internal division. And one more benefit that from the X division, it will be defect free. So this is the reason why we have not incurred any kind of a loss on outside purchases. We have not incurred any kind of loss from outside purchase. That means individual division best strategy will become the best strategy for a company as a whole. Will become best strategy for company as whole. See everyone, this statement you have prepared this statement showing decision whether to expand or not. You have prepared this. You have prepared this statement showing net revenue addition. You have prepared this statement showing internal transfer decisions units, how many number of units will be transferred. So 5,000 units has been transferred to division Z, 2,000 units has been transferred to division Y. You have prepared this statement showing contribution per unit, where we have calculated this 11, 10, 11, 9, 9 and 14. How the transfer price has been set, transfer price calculations has been given here. And at last you have to mention what is the best strategy for the company and divisions. Best strategy for company and a division. So division X will transfer the maximum possible material to division Z, and as division Z is offering the maximum transfer price to division X, so for division X it has to transfer the maximum possible units to division Z. At the same time, division Z is fetching maximum contribution for the organization, so it is beneficial for both division as well as organization as a whole, because it is not involved in the outside purchase. As shown in above, all three divisions are getting net benefit when they are taking decisions to expand. Hence, all three decisions should expand their activity by incurring additional fixed cost on expansion. This is what the best strategy for company divisions and for company. So what will the best strategy for division X? Expand and transfer maximum units to division Z. What will be the best strategy for division Y? Purchase material X from division Y and expand. What will be the best strategy for division Z? Purchase from division X and expand. This is what will become a best strategy for company as a whole as well. Any query from question number second? Any query from question number second, you are free to ask. I'm here to take your queries on question number second. If you have any query, you may ask. Any query, any doubt from your side? Sir, it was quite a lengthy question. Indeed, we can expect this in our exam. Yes, dear Suyashi, it can be asked in your examination. Even this question is a question which has been asked in your old course. This same question has been asked in your old course, and same question even can be asked in your new course, right? The same question has already been asked in your old course. So definitely it has a chance to be asked in your new course, and it will be completely of 20 marks. So take a risk call at your end. So anyone have queries from this question number second? If no, then we are moving to the question number 5th. We are moving to question number 5th. Question number 5th. A manufacturer has two divisions, division A and division B. Division B produces components that are used by division A. That are used by division A as well as external customers. So we will be more comfortable. We will be more comfortable if we use our method. That is how we will interpret, how we will be understanding question through drawing it. Question number 5th. Right. So what it is saying, a company has two divisions. Company has two divisions. Division A and division B. Division B produces components that are used by both division A as well as external customer. Okay, so let me change this. This is division B and division A. Division B and division A. It transfers all its requirement to division A. So it does the external sales as well as internal transfer to division A. Annual production capacity is 1 lakh. Its annual production capacity is 1 lakh units. The division operates at full capacity. No inventory at the beginning and at the end of the year. It sells its component to external customers at 4,000 rupees per unit. Selling price 4,000. Variable cost of production for the component is 2,750. $2,750. Internally, it transfers its component to division A, factoring any opportunity cost in the form of lost sales. That means it will transfer at variable cost plus opportunity cost. The transfer price will be based on variable cost plus opportunity cost. Right. So total sales of division B were rupees 36 crores. The total sales ₹36 crore, of which the sales to external customer is 20 crore rupees. It has 20 crore rupees sales, 20 crores sales. If we have selling price 4,000 rupees, can you tell me the number of units? Can you tell me the number of units sold to the external customers? Number of units. Can you determine what the number of units? 20 crores divided by 4,000 rupees. And the balance is 16 crore rupees. 16 crore rupees revenue generated from the internal transfer. Fine. Good. Can you tell me this quantity, 20 crores, 20 crores divided by 4,000 rupees selling price, 50,000 units. 50,000 units has been sold to the external customers, and definitely the 50,000 units is sold to this division. Okay. Yes, very good. Suyashi, Koshni. As per the company's policy, the demand from division A has a priority over external customer. That means first it has to meet the demand, internal division demand, then it can do the external customer sales. This year there was an additional demand from the customer for 18,000 components. However, since division B operates at full capacity, this demand was not catered. It is saying there is an additional demand, external demand of 18,000. 18,000 units additional demand. But it cannot do because it is transferring 50,000 units to division A and 50,000 units to external demand, external sales. That means now in this situation, division A is sacrificing, division B is sacrificing 18,000 external demand in order to supply internal division. So there will be opportunity cost on 18,000 units. Analyze the sales in the terms of rupees and units made by division B to both external and internal customers. See, we have already done here. External and internal. Sales analysis. This is sales analysis. Rupees, it will be 20 crore rupees. It will be 16 crore rupees. Balancing figure. And the number of units, 50,000 units and 50,000 units. As we have 1 lakh capacity, total capacity is 1 lakh. So this was the first part, but we need to analyze it, analyze the sales, right? So let's move to this part. Namita, I will take this query or of the previous question at the end. See, the sales analysis of division B. This is the kind of answer you are expected to write in answer. Analysis, not only just calculation, but analysis. Under analysis, you have to tell the reason of the situation, current situation, or the past what has been occurred. It is saying the total capacity and the annual production of division B is 1 lakh units, right? Zero inventory implies the sales for the year is also 1 lakh rupees, 1 lakh units. Sales to external customer was 20 crore rupees at 4,000 per unit. Therefore, the units sold to external customer would be 50,000 units this year. We have done through this. Therefore, the internal sales can be derived to be 50,000 units for the year. Annual sales 1 lakh units less external sales. For the year, value of sales made to division A is 16 crore rupees. That is balancing 36 crore minus 20 crore rupees. Had there been no extra demand, opportunity cost for division B would have been nil. Therefore, transfer price would only be variable cost 2750 per unit of the component. It is saying if there would have been no external demand of this 18,000 units, then the transfer price would have been variable cost. We could only consider as a variable cost. However, in the given problem, there was excess demand of 18,000 units of the component from the external customer. That could mean since division B had given priority to the internal demand. This is the reason why we are sacrificing external demand, 18,000. Had these sales been made, division B would have earned 1250 rupees per contribution. What is the contribution? Contribution is 1250 rupees, right? On if these 18,000 units would have been sold, 1250 rupees would be the contribution we would be earning. Contribution. Now this is sacrificed. On how many number of units? 18,000. So for 18,000, from this we can analyze that 50,000 units. This 50,000 units has a two part. 18,000 units and 32,000 units. On this we have a contribution loss. Of 1250. So here This loss contribution of 1250 is the opportunity cost per unit of for division B due to the company's policy of giving priority to the internal demand. Division B lost a profit of 2.2 crore during the year. That is 18,000 into 1250 per unit. Therefore, the internal sales comprises the two part. 32,000 component transferred at a variable cost. This has been transferred at variable cost 2750. And this has been transferred at variable cost plus opportunity cost, that is 4,000. This amounts to 7.2 crores. Therefore, internal sales is 8.8 crore plus 7.2 crore. Total is 16 crore. Total is 16 crores. Summarizing, external sales are 50,000 amounting to 20 crore annual sales, internal 50,000, 16 crore annual sales. Transfer price for 32,000 is variable cost units, while for 18,000 external sales price is 4,000 per unit. Recommend the transfer price range that would promote the goal congruence between division A and division B. Recommend the transfer price range that would promote the goal congruence. So we know that we have minimum transfer price, variable cost 2750, opportunity cost, yes, this will incur 1250, but this transfer price will be on 18,000 units. So it will be 4,000. What will be the transfer price, minimum transfer price on 32,000 units? It will be variable cost 2750, opportunity cost will be nil, so 2750. Average minimum transfer price 4,000 into 18,000 plus 2,750 into 32,000 divided by 50,000 units. You will be getting your minimum transfer price. Maximum transfer price will be 4,000 rupees. So the range will be 4,000 into 18,000 plus 2750 into 2750 into it is 3,200 rupees. So the range will be 3,200 to 4,000 rupees. So the division A procured its entire demand of 50,000 units from division B. Out of this, 18,000 units at 4,000, while 32,000 procure at lower rate of 2750. Had division A procured 32,000 units from the market, the additional cost of procurement would be 4 crore rupees. That is external price of 4,000 per unit less the internal transfer. This only division A currently enjoys this benefit of the lower procurement cost. Financials of division B shows no profit from such internal transfer. This may screw the performance assessment of division if it is based primarily on the financial metrics of each division. In order to promote goal concurrence, some portion of this benefit can be shared with division B. This will be at the minimum want to recover its variable cost per unit, while division A will be ready to pay up to the external price of 4,000. So therefore transfer price range can be set between this. A enjoys lower procurement rate. B, division B's financial reflects some benefit of transferring component internally to division A. See, this is what requirement. Let's see requirement again. Yes, the average minimum transfer price. Recommend the transfer price range that would promote the goal concurrence. So it is asking about the promoting the goal concurrence. 200 rupees is the average, but it will not motivate the receiving division because it is anyways it is going to it is incurring it is going to it is if transferring division is going to transfer at 3,200 rupees, it is not going to motivate the transferring division. If the receiving division is going to receive at 4,000, it is not going to be motivated. So if there is any benefit, the benefit should be shared. That is what the transfer price should be can be 3,500 rupees, can be 3,600 rupees, can be 3,300 rupees, right? That means it should be below 4,000 rupees. That will motivate to the receiving division as well. And anything above 3,200, it will definitely motivate the transferring division. Definitely it will motivate the transferring division. Discuss the effect of change in external demand on transfer price for company assuming the current policy continues. As per the company's transfer pricing policy, division B is priority to demand from division A. The division A has the capacity of 1 lakh units annually, right? If there is no external market for division B's component, then the transfer price for the entire internal would be 2,750 per unit, plus a portion of fixed cost, if any. This is the minimum cost that division B would like to recover from division A. When there is an external market, this situation was no external market. This is for external market. Division B had to incur opportunity cost in the form of the lost sales. When total demand, internal and external, is within the production capacity 1 lakh units, the entire demand can be met. There will be no lost sales, no opportunity cost. Therefore, the transfer price of the entire internal transfer will be variable cost 2,750 per unit. This is the minimum cost that division B would like to recover from division A. When there is external market, such total demand is more than the capacity. That is more than capacity. Here we have more than capacity. Demand more than capacity. Due to its prior given internal transfer, some portion of the external demand might not be met. This would be the lost sales for division B. Opportunity cost would be the contribution lost, say from sales, that is 1,250 per unit. This opportunity cost would be passed on to division A. As explained in part second, above, transfer price will range from 2750 to 4000 per units. More lost sales of division B would keep the average transfer price higher towards 4000. See, currently we are losing 18,000 units. So the transfer price is 3200 rupees. If we will be losing 20,000 units, it will rise something 3250 or 3300 rupees. If we start losing 25,000 units, it will be some more close to 4,000 rupees. It is what saying. More lost sales for division B would keep the average transfer price higher towards 4,000 per unit. Lesser lost sales for division B would keep the average transfer price towards lower bounds to 2750 per units. That means if this is 5,000 units which we are losing in external sales, our transfer price will be more close to 2750. Therefore, the portion of external demand that could not be catered to would determine the average transfer price. Higher the demand from external customer would drive up the average transfer price within the company. This is what the third requirement. If anyone have queries from first, second, third part, you can ask. Okay, let me now take the question of Namita. Sir, while taking expansion decision, why we take contribution only? We should take fixed cost as well, because X will incur 45,000 but recover only 19,000. Dear Namita, please see here. Namita, this is the 45,000 rupees, the cost which has been incurred as a fixed cost, additional fixed cost for increasing the capacity, That means it is not any normal fixed cost. This additional fixed cost has been incurred to increase your capacity. Right? So at least from the additional capacity, we must earn 45,000 rupees. Right? Clear? So 45,000 rupees, we will be taking it from additional contribution, additional capacity. The additional capacity, this 6,000. 4,000 has been transferred to Z and 2,000 has been transferred to Y. This will yield us a contribution of 11 rupees. Why we are not taking revenue? Because revenue consists of variable cost. So variable cost will be excluded. So portion remaining with us is a contribution. That contribution will contribute toward recovering our fixed cost. So this 44,000 plus 20,000, the total is 64,000 rupees. This 64,000 rupees is contributing towards 45,000 rupees. And after recovering all 45,000 rupees, we have a surplus. This is a surplus of 19,000. This is the reason why we are taking this. Sir, is the answer of second part is wrong in the study material? See, they have given you the range 2750 to 4,000. We have calculated the exact amount that should be quoted. The minimum transfer price, right? So this is what they are telling, that this will be a range. But we have calculated the minimum transfer price. Meena, sir, can you explain the part number third in numbers? It's purely theoretical. a bit confusing. Okay, let me try to explain. The objective, Meena, the objective is to say, see, our minimum transfer price is 2750, right? Maximum transfer price is 4,000 rupees. It says if the external sales sacrificed, currently we have 18,000. Currently we have 18,000 external sales which has been sacrificed. So our minimum, our price will be 3,200 rupees. 3,200 rupees minimum transfer price. If the external demand sacrificed will be 25,000, it will be more towards 4,000. When it will be 5,000 units, that is lesser units, this will be more towards this. That is, it will be more toward 2750. Lesser quantity, lesser units sacrificed. If higher quantity of external sales is sacrificed, then our transfer price will move towards 4,000. If lesser quantity, it will move towards minimum transfer price. This is what about the conclusion part. Namita, the range will be more appropriate 3,200 to 4,000. The more appropriate will be 3,200 to 4,000. Meena, is it clear? Meena, the third part is clear. It is saying higher quantity sacrificed, external sales sacrificed, our transfer price will move towards 4,000, will move more closer to the 4,000. That means you can put any random number, 25,000, 30,000, 40,000. It will be more towards 4,000. But when we sacrifice only 5,000, 1,000, it will be more close towards minimum transfer price. This is what. Meena, is it clear? Meena. Namita, clear? Is it clear? The question number third, which we have discussed, a second question we have discussed. Your query regarding expansion decision. Okay, so further, if you have any query, you can post, or if it's all clear, we will be ending our today's session. It's my pleasure, Meena. Okay, so thank you so much, everyone, for today's session. Good night. Bye-bye, everyone.